This is David Harvey, and you're listening to the Anti-Capitalism Chronicles, a podcast that looks at capitalism through a Marxist lens. This podcast is made possible by Democracy at Work. Welcome to this week's edition of the Anti-Capitalism Chronicles. As usual, I'm deeply indebted to Democracy at Work for putting this on the air and doing all the work that's involved with its production. This week I thought I'd reflect on a question I got in an interview I did earlier this week. And the question was, how come the United States ran such a huge foreign indebtedness position? And what benefits came to the United States by virtue of that? My instantaneous answer, without really thinking about it too much, was that I didn't think the United States really did benefit from it very much. I then reflected a little bit and said afterwards that, well, maybe some people in the United States benefited from it, but the population as a whole in the United States certainly did not. And then the question that followed up was, well, if that's the case, why does the United States, with all of its power, actually tolerate this situation? And my answer was, well, I think it was a great policy mistake, a miscalculation, and that there was no intention of ending up in this situation, but that the fact that in 2008, for example, the main holders of U.S. treasuries were countries like China, Russia, Japan, and so on, that was a situation which was not beneficial at all. And there's arisen for a very simple reason. And I think the main reason was this, that back in the 1960s, American corporations were protected against foreign competition by the structure of the Bretton Woods Agreement, which inhibited capital controls. That the relaxation of those capital controls with the abandonment of the Bretton Woods Agreement in, I think it was August 15th, 1971, that moment meant that the U.S. would have to stand up to a foreign competition, that the free flow of foreign capital coming into the United States or U.S. capital flowing abroad, all of that changed the name of the game during the 1970s, and so we had a different world order which emerged during those years and has been perpetuated in effect to the present time. So this then was the situation. But this raises two questions. First, why did the United States abandon the Bretton Woods Agreement? And the answer had to be, in part, because it was inoperative and untenable, because over the years, dollars, which were essentially controlled by the U.S. Treasury and the U.S. Central Bank, were getting out of control. And there emerged something called the euro-dollar market, which were dollars which were held by European banks or by branches of U.S. banks in Britain and Europe. And the euro-dollar market meant that a large segment of dollar trade was now outside of the regulatory apparatus that existed in the United States. So that was one aspect of it. The second aspect of it was that the bankers in the United States, the financial interests in the United States, were very, very interested in trying to open up global trade because they saw many opportunities to facilitate foreign investment, and for them this was very, very profitable. The biggest windfall for them came after 1971. It came in 1973 to 5 during the Gulf crisis, and at a time when U.S. capital was having a hard time. A large amount of dollars was going to the Gulf states, and the United States used its military power and its diplomatic might to insist that the Gulf states actually invest all that money in the global economy via the New York investment banks. So suddenly the New York investment banks came flush with a great deal of money, And this kind of trade would have been impossible under the Bretton Woods Agreement. Therefore, what 1971 did was to open up the possibility for a much greater influence over public policy of the bankers and so on, which then happened. But where did the miscalculation arise? The miscalculation came, I think, because the idea was that the U.S. corporations and manufacturing industries and so on were so good, so superb, and so powerful that there was no way that they could be bested by foreign competition. Now, we can go sector by sector to see if that was really the case, but I think the automobile sector is the one which is most telling. In the 1960s, in the United States, there were 3 auto companies that held to an oligopoly position. They engaged in price leadership. They struck the same kind of union contracts and so on, so that there was a working class element involved in how those corporations operated. So you had Ford, General Motors, and Chrysler, who were essentially the kings of the castle in terms of the U.S. automobile. And of course, the automobile in the United States was sacrosanct, and so everybody assumed that this whole kind of opening up to foreign trade and all the rest of it would simply enhance the position of Detroit and actually open up all kinds of possibilities in foreign markets. Well, some of that did happen, but the reverse happened, and by the time you got to 1980s, suddenly you find that the automobile industry in Detroit is under serious competitive pressure coming from the then West German automobile industry, particularly BMW and Volkswagen, and a great deal competition was also coming from the Japanese auto industry and Toyota and so on. So by the time you get to the 1980s, Detroit is in serious, serious trouble because the foreign auto companies are essentially dominating the U.S. market. And that domination was for a particular reason. That during the 1960s, the automobile industry started to reorganize themselves and their leadership changed. In the 1950s, 1960s, the leadership in the automobile industries tended to be drawn from deep knowledge of engineering. So innovations in automobile design and so on, and it was very dear to the heart of the engineers. And so the engineering basis, if you like, of the Detroit industry was very strong in the 1960s. But by the time we get towards the end of the 1960s, that leadership has changed. It's more and more led by financiers and by accountants and so on. And so the interest of Detroit was less and less about engineering of cars and more about making money. And so the monetary aspects of things became very significant, so that monetary operations started to be incorporated within the Detroit auto companies. For example, the opening up of foreign trade meant that, and the change of in currency markets meant that you could speculate a great deal in foreign exchange relations, and you could, and given that the automobile companies had interest in Latin America and Europe and so on, commodity futures and trading in foreign exchange futures and so on started to become part and parcel integrated within the company. And in some respects, that became even more profitable than making cars, and it became more of, therefore, a greater and greater interest to the Detroit people. But the result was that American cars turned out not to be anywhere near as good as the Japanese and the West German cars. So that, for example, when I bought a car in 1987, I didn't even think about buying a U.S.-made car. You automatically thought, Toyota or Volkswagen or even a Saab or a Volvo or something of that kind. So in effect, what the policy presumption which had existed in the 1970s that the U.S. industrial structure would become all conquering turned out to be false. It was the other way around. Actually, the all-conquering automobile industries in the 1980s were primarily Japanese and to some extent West German. So, and what that led to, of course, was a bigger impact upon the trade balance. This is the sort of thing that led further and further and further into sort of United States becoming a debtor country in terms of its foreign trade balance. Now, this then leads us immediately into the kind of question of the kinds of things that go on in terms of corporate governance. And I think in this regard, I go back to a book that a colleague of mine at Johns Hopkins University wrote some time back now, called The Cultural Crisis of the Firm. And one of the things she pointed out was that actually firms are not simply run by economists and automatons who are kind of playing the game of the perfect economic calculator. There is a culture to the firm, and the culture is sometimes misplaced in relationship to economics. And as a result of that, bad economic decisions are made for cultural reasons, and the bad economic decisions lead into crises in particular firms. For example, she worked a great deal on the case of McDonnell Douglas, where there were some obvious things that needed to be done in the face of changing defense requirements. But McDonnell Douglas failed to do them because the culture of management and so on was kind of set in stone, and they really couldn't do it for cultural reasons. And the result is that the company started to fail seriously for economic reasons. And we've seen this sort of thing going on in Detroit as well. So this cultural crisis of the firm leads into the kind of question as to why is it that capital produces corporations and practices which are actually deleterious in the long run, both to the macroeconomy in the sense of the trade balance, but also in terms of employment and investment structures internally, but also deleterious even from the standpoint of the company itself. A more recent example of exactly this problem comes up in the semiconductor industry, where, 20 years ago, a firm like Intel was very much in the lead, but there were certain kind of innovations coming online, and Intel was comfortable in what it was doing and looked at these innovations and said it wasn't going to really pursue them because it was going to take a lot of extra money and re-engineering and reconfiguration of what was going on in the company. So Intel sat there with its with a very good situation at that time. But at that time, another company, which was the Taiwanese company, which is the Taiwan Semiconductor Manufacturing Corporation, TSMC, took up these innovations and started to run with them. And by the time you get to about 10 years ago, TSMC is way, way ahead of Intel in terms of its market share and its profitability and its size and all the rest of it. So TSMC now is the chip maker, which is responsible for about 80% of the most advanced chips, which were created with the new technology. And Intel is way behind and is now actually trying to catch up by spending a lot of money, billions of dollars to try to catch up. But the Taiwanese company is way, way ahead. And here, too, it was a company decision that actually led into this. And it raises this kind of question of, are we going to spend a lot of time sort of praising how brilliant the market system is and how brilliant American corporations are in terms of their management structure, when we have plenty of examples of this kind, which show that, in fact, the drive, which is supposed to be there, is not there for cultural reasons. But then there are other answers to this question as to why is it that capital ends up doing things which are actually negative in relationship to its own reproduction. And this, of course, is where Marx comes in very, very strongly. So whereas contemporary economics, generally speaking, feels that the market will, at some point or other, lead everything to converge into some equilibrium. What Marx does is to identify the contradictions that lead into crises of capitalism and what those crises do in relationship to output and employment and all the rest of it. Now, there are three ways you can look at this. The first way is to say, well, look at it from the standpoint of the individual firm. The individual firm will adopt technologies which further its own particular interests. And in adopting those technologies, it creates a technological world which may actually play a negative role in relationship to the future of capital accumulation. In other words, individual capitalists operating in their own self-interest do things which in aggregate create a negative situation for the reproduction of capital. The most obvious example of this comes in the case of technological change and Marx's theory of relative surplus value. Now, I encountered this in a sort of discussion I had in New Left Review about rates and masses, where somebody said to me, or one of the critics wrote and said, well, why would an individual capitalist engage in technological change when that technological change raises the productivity of labor, and that increasing productivity of labor means that you employ fewer laborers, and if you employ fewer laborers, if you take the labor theory of value, then you're going to have less surplus value, which means that there's going to be a falling rate of profit. So you get the thesis of a falling rate of profit arising out of rising productivity of labor, and that rising productivity is powered by individual capitalists adopting the innovations. Why would somebody do that? Why would somebody adopt that technology when the output means a falling rate of profit? It doesn't make sense. Well, it makes sense when you introduce the idea that individual capitalists operate in the context of what Marx calls the coercive laws of competition. And the coercive laws of competition are such that if I have a better technology than you, I'm going to get a bit of surplus value more than you. So I'm going to get higher profit rates. And over time, I'm likely to drive you out of business because I have more surplus value than you have. The result of that is that the response to the coercive laws of competition is that I make an innovation, you're going to follow my innovation and catch up with me and even go beyond me. So it is the coercive laws of competition which force people to adopt technologies which are labor-saving and which therefore reduce the labor input and which therefore have an effect to the falling rate of profit. So, in other words, there is a rational reason why somebody who has no interest in a falling rate of profit will engage in practices which actually lead the profit rate to fall. So this is Marx's argument. So in this case, we would say it's the way in which individual actors are supposed to come up with technologies and so on which improve their own position, but do it in such a way as to actually reduce the capacity for the reproduction of capital in general. So that's the first part of the story. The second part of the story really comes out from individual sectors, in the sense that it's hardly as if the energy companies feel that they're actually duty-bound to behave in such a way as to support the reproduction of capital accumulation. No, they're out there to make a profit, and so you find a whole sector, like fossil fuel sector, which is going to engage in practices and so on, which are going to redound to its own benefit, which will be negative from the standpoint of the economy as a whole, and certainly negative from the standpoint of environmental conditions and all the rest of it. So individual capitalists operating in their own self-interest are part of the problem. Sectors or large corporations and monopoly groups are another reason why the economy is likely to drift off in a negative direction, because each individual sector will pursue its own interests, and in pursuing its own interests will actually, in some instances, support the further accumulation of capital, in other instances, subtract from it. So that, for example, if we look at what is happening in terms of land markets or something of that kind, landlord interests can enter in, property owning factions can enter in, all kinds of things like this can happen, which actually, therefore, set up rational reasons why a capitalist economy can never advance cleanly and purely into the future. So there are those sorts of issues which crop up, and I think that actually, when you start to look at it in the history of capitalist corporations in the United States, we see many instances in which corporations get themselves into a mess and go even further. So we have things like the Enron debacle at the end of 1998. You have investment speculative crashes like long-term capital management in 1998. So the point here is that the United States became a debtor country, not because there was some policy decision made that that's a good idea, but a set of policy decisions were made and a set of individual initiatives occurred, which actually then forced the economy as a whole to move down a channel in which the U.S. ends up being a debtor country, big time, and now we're sort of stuck with that as a fact. Now, being a debtor country, is that good for the United States? Well, certain people, it's very good. One of the things I think that renders some other countries nervous about holding American debt is that, of course, if, as in the case of Russia right now, suddenly something goes negative, the United States is always in a position to sort of sequester all the funds the Russians have in U.S. debt and prevent the Russians using that debt in any way to support their economy. So you come a bit vulnerable if you hold U.S. debt and then the U.S. starts to playing games with it. But it's very dangerous for the U.S. to start playing games with it, because then nobody's going to buy U.S. debt and take up U.S. debt. So you have to be very careful about how this works out. But generally speaking, Wall Street is quite happy to have U.S. hugely indebted, because Wall Street deals with the buying and selling of U.S. debt, and of course that means they get all the commissions and all the rest of it. So that Wall Street is not really too perturbed about the U.S. debt. On the other hand, Main Street and the population in general may find the problem of the U.S. debt problematic in the sense that it has an effect upon interest rates and all the rest of it. So you can start to trace back lots of good and bad effects of being indebted throughout the whole of the U.S. economy. Now, this habit, however, of imagining that somehow or other U.S. capitalism and U.S. Capitalist corporations somehow or other excel in their capacities and powers, turns out to be absolutely not the case. And we have all of these examples of companies which steer themselves into, if not bankruptcy, but into second-rate status. I mean, Intel is now a second-rate company compared to TSMC. And there's now this kind of problem of exactly how to deal with this situation, given the fact that TSMC is a company in Taiwan, and Taiwan is a problem in the sense that it is considered by the Chinese to be a province of China, and considered by everybody else to be an autonomous state. And the kinds of issues that crop up with that, which I think I will talk about next time. But here is, if you like, the main thing. Never assume that economic rationality leads to, at one level, it conforms to economic rationality at another level. When Marx talks about the falling rate of profit, he's talking about economic rationality at the individual firm level, which leads to behaviors which create economic irrationality in the macroeconomy. And that is going on all of the time. And when we introduce sectors into it and so on, you can see immediately that this idea that the market is going to lead, or economic rationality is going to lead to a rational kind of result in the form of of an equilibrium economy where everything is kind of worked out kind of nice and cozily, that is unlikely to be the case, and we're therefore almost certainly going to have signs of economic irrationality all over the place, which are powered by economic rationality at a different level. And that is one of the major findings that Marx has, which says that it's the internal contradictions of capital which lead into crises of various kinds. The macroeconomy goes down the chute because individual capitalists are behaving rationally. And it is therefore, in Marx's argument, there's nothing essentially leading to a rational outcome, leading to the major irrationality of a crisis, the sign of which is that you have surpluses of labor, surpluses of capital, side by side, and seemingly no way to put them back together to meet up with real chronic social need. This is the situation as it existed in the 1930s. There were massive amounts of unemployed population, massive amounts of unemployed capital, not knowing where to go. There was a crying social need to build things, and nobody was able to do it because of the irrationality and the resulted from all of the individual behavior. The result, of course, was that Keynesian thinking came in which the state stepped in and said they were going to behave as a super rationalizer for the macroeconomy by actually overcoming many of the irrationalities which were arising out of the individualistic form of the economy. And that seems to me to be one of the primary lessons that we would draw from this situation. So do not assume that a capitalist economy is rational. Assume individual moments of it can be rational, but they produce irrational results. And that's the situation that goes on and on and on. And we will talk further about some of these irrational calculations in the next podcast. Thank you for joining me today. You've been listening to David Harvey's Anti-Capitalist Chronicles, a Democracy at Work production.